Good day everyone, I am Diane Marie Alcashan and today our group will be reporting all about note payable. So kani nga topic kay makuha ni siya nga murag familiar na nato gamay because nakaagi naman tag accounts receivable and loans receivable. So pero ang kaning notes payable kay bali siya, so imbis kita mo'y mag-receive, kita mo'y mo hatag. So next slide please. So, the technical knowledge of this chapter will be to define a promissory note, to know the initial measurement of note payable, to understand the subsequent measurement of note payable at amortized cost, to understand the fair value option of measuring notes payable, and to know the accounting for notes payable issued solely for cash, interest-bearing note payable, and non-interest-bearing note payable issued for property. Next slide, please. So, by definition, notes payable is a promissory note in an unconditional promise in writing made by one person to another, signed by the maker, engaging to pay on demand or at a fixed or determinable future time a sum certain in money to order or to bearer. So, next slide please. So, initial measurement of note payable. So, initially, kay kuan ni siya not designated at fair value through profit or loss, and it shall be initially measured at fair value minus transaction costs that are directly attributable to the issue of the note payable. So, meaning, dili kay ang designated fair value ra, dapat ka nang minusan nimo siya sa transaction cost and other directly attributable costs. So, in other words, transactions costs are included in the measurement of note payable. However, if the note payable is irrevocably designated at fair value through profit or loss, the transaction costs are expensed immediately. The fair value of the note payable is equal to the present value of the future cash payment to settle the note payable using market rate of interest. So to simplify, kay magkuha ka sa fair value, then minusan nimo siya og mga transaction cost o directly attributable costs. So next slide please. Subsequent measurement of note payable. So, PFRS 9, paragraph 5.3.1 provides that after initial recognition, a note payable shall be measured. At first, at amortized cost using the effective interest method. So, kaning effective interest method I'm assuming that we're all familiar of this method because since far pa ni siya nga method hangtod sa intact 1 and naigamay sa intact 2, and then so yeah, I'm assuming that everyone knows this method. Next is at fair value through profit or loss if the note payable is designated irrevocably as measured at fair value through profit or loss. So, in addition, the amortized cost of note payable is the amount at which the note payable is measured initially, minus principal repayment, then plus or minus the cumulative amortization using the effective interest method of any difference between the face amount and present value of the note payable. Actually, the difference between the face amount and present value is either discount or premium on the issue of the note payable. So, to illustrate all the theories, we will be having an example. So, notes issued solely for cash. When a note is issued solely for cash, the present value is equal to the cash proceeds. So, ang present value daw kay equal to the cash proceeds. So, an illustration is, on November 1, 2020, an entity discounted its own note of 1 million at 12% for 1 year. So, as you can see, ang imong note payable is 1 million. I-times na nimo siya 12%, kay naman dire 12%. So, and then ilas na siya nimo, man na siya imong net proceeds or ang imong cash proceeds. And then, journalize na nimo kay mo debit ka og cash nga 880, mo debit po kag discount on note payable 120,000 and mo credit ka og note payable nga 1 million. Ang kaning 120,000 nga amount kay total interest expense ni siya for 1 year. Diba nagkuan man ka og November 1, 2020. November 1, 2020 ma-end na siya ig October 31, 2021. So, thus on December 31, 2020 kay diba nag-start makag November ay nakuan man ni siya November. So mag-count ka kay i-apil nimo ang November since November 1 month. So November 1 ay November then December, so 2 months. So, kana nga months kay ma-recognize na siya nimo ang expense. So, mo-debit ka og interest expense 20,000 and discount on note payable 20,000. So, to de-recognize the discount. So, mo na siya giun sa man siya ang 20,000. So, simply nga calculate ka og 120,000 mo na siya ang imong kabuuan nga discount on note payable, i-times na mo siya 2/12 since 2 months sikad November o December, and then divided by 12 kay 12 months man. So, in addition, the straight line method is used in amortizing the discount on note payable for simplicity. Besides, the note payable has only a term of 1 year. If a statement of financial position is prepared on December 31, 2020, the note payable is classified and reported as current liability. So, kanang to illustrate. So, di ba, ang imong note payable kabuuan kay 1 million. So, discount on note payable nimo, di ba, 120,000 man to. But then, naka-recognize na makag 2 months sa expense. So, 120,000 minus 20,000, 100,000 na lang. So, ang carrying amount sa imong notes payable is 900,000. Observe that the discount on note payable is a direct deduction from the face amount of the note payable. The carrying amount of 900,000 is actually the amortized cost of the note payable. That would be all for my report, and let us now hear from the next reporter. Thank you everyone and good day.
Today I'm gonna discuss interest-bearing note issued for property. So when a property or non-cash asset is acquired by issuing a promissory note that bears interest, accounting principles require the transaction to be recorded at the purchase price. So the purchase price represents the agreed upon value of the property or asset that is being acquired. So the key point to understand here is that the purchase price in this case is assumed to be the present value of the promissory note. Present value is a financial concept used to calculate the current worth of future cash flows or payments, considering the time value of money. In other words, it accounts for the fact that money received in the future is worth less than the same amount of money received today due to inflation and the potential to invest money for returns. So when the promissory note is interest-bearing, it means that the issuer or the party acquiring the property is committed to paying not only the principal amount, but also the interest over time as compensation to the note holder or the party selling the property for the time value of money. So to illustrate this, let's consider an example. On January 1, 2021, an entity acquired an equipment for 1 million pesos, payable in 5 equal installments every December 31 of each year. So interest is 10% on the unpaid balance. Next slide. So here are the journal entries. For January 1, 2021, we debited equipment 1 million and credited note payable 1 million. So in December 31, 2021, we debited interest expense 100,000, note payable 200,000, and credited cash 300,000. So in getting the 100,000 for the interest expense, we multiply the percent times with 1 million. So for 2022, on December 31, 2022, we debited interest expense of 80,000 and note payable of 200,000 and cash 280 and credited cash 280,000. So by getting the 80,000 is same process for last 2031, 10% times 800,000. Next slide, please. So now, let us proceed in non-interest bearing note issued for property. So when a non-interest bearing note is issued for the acquisition of a property, the property is recorded on the buyer's books at the cash price of the property. So the cash price represents the agreed upon value of the property that is being purchased. And in this case, it is assumed to be the present value of the non-interest bearing note. So the concept of present value is crucial here as well. Present value is the value of future cash flows in terms of today's dollars, taking into account the time value of money. So when a non-interest-bearing note is used, it means the buyer is not required to pay any interest on the note over its term. So to illustrate this, let's consider an example. On January 1, 2021, an entity acquired an equipment with a cash price of 350,000 for 500,000 and 100,000 pesos down, and the balance payable in 4 equal annual installments. So next slide, please. So here is the table of amortization for year 2001 until 2024. So note payable, fraction, amortization. So note payable represents the amount outstanding every year, and fraction is developed from the note payable outstanding every year. And amortization is the amount of discount multiplied by the fraction developed. So for 2021, we have a note payable of 400,000 and a fraction of 4 over 10. So how can we get this 4 over 10? So all the notes payable, since we total all the notes payable, we get 1 million. So we get 4 over 10, 3 over 10, 2 over 10, and 1 over 10. In getting the amortization is we multiply 400,000 by 4 over 10 to get 60,000, and so on and so forth. So in amortization, the total we get is 150,000.
Hello, I am Shala Rublico and I will be the next reporter. And now let us have an illustration for no cash price. We have here our problem. On January 1, 2021, an entity acquired an equipment for 100 million payable in 5 equal annual installments on every December 31 of each year. So we can observe that there is no agreed interest and no cash price is available for the equipment. So in such a case, the cost of the equipment is equal to the present value of the 200,000 annual installment in 5 years at an appropriate rate of 10%. So how did we get the 200,000? Simply by dividing 1 million payable to 5 equal annual installments, then we get 200,000. And the rate of 10% is assumed to be the prevailing market rate of the interest. The present value of an ordinary annuity of 1 for 5 years at 10% is 3.7908. So how did we get 3.7908? Simply 1 plus 10%, then click the divide button and then click the equal button 5 times. Then we will get 3.7908. Therefore, the present value of 200,000 installments is 758,160, computed by multiplying 200,000 by the present value factor of 3.7908. And now let us have our journal entries for 2021. On January 1, since we acquired an equipment for 100 million payable, then we will debit equipment and then credit note payable for 1 million pesos. And then the equipment is 758,160, which is our present value. And then we also debit discount on note payable, which is 241,840. And on December 31, we debit note payable amounted to 200,000 and then credit cash 200,000. So ato na siyang gi-debit ang note payable because this is our first installment payment. So makuha na tong payable of 200,000. And then our next entry would be debit interest expense and credit discount on note payable amounted to 75,816. So how did we get 75,816? So first, we have to make a table of amortization. So we have here our table of amortization. Our first column is the date. Our second column is the payment. Our third column is the interest. The fourth column is principal, and the last column is the present value. Our payment column represents the annual installment. So, maong na ni siya 200,000, which is katong annual installment nato, 100 million, 1 million divided by 5 annual installment. So, we have 200,000. And then, the interest column is equal to the preceding present value, which is 758,160, multiplied by the implied interest rate of 10%. Thus, for 2021, 758,160 times 10% equals 75,816. And our principal column is the portion of the payment after deducting interest representing principal. Thus, on December 31, 2021, 200,000 minus the interest of 75,816 equals 124,184. And the present value is the balance of the preceding present value after deducting the principal payment. Thus, on December 31, 2021, 758,160 minus 124,184, then we will get our present value of 633,976. So, on December 31, 2021, the current portion of the note payable should be reported as current liability. So, as of December 31, 2022, our current liability is 136,602. So, how did we get that? December 31, 2023, we have 200,000 annual installment minus our interest expense, which is 63,398. Then we will get our current liability of 136,602. And for the non-current portion of the note payable should be reported as non-current liability. So, from the date December 31, 2023 to December 31, 2025, the remaining annual payment would be our current liability note payable. So, 200,000 times 3, which is 2023, 2024, and 2025, then we will get a note payable of 600,000 minus 102,626, which gikuha nato by adding the interest expense from 2023 to 2025, then we will get 102,626. And then ato siyang i-deduct sa note payable, which is a remaining 600,000. Then we will get our non-current liability, which amounted to 497,374. And that will be the end of my report. And now let us proceed to the next reporter.
I am Ina Lauren C. Fernandez, and I will be reporting about non-interest bearing note payable lump sum. So, a note payable is an unconditional written promise to pay a specific sum of money to the creditor on demand or an undefined future date. It is supported by a formal written promissory note. So, these notes are negotiable instruments in the same way as checks and bank drafts. Notes payable are initially recognized at the fair value on the date that the note is legally executed, or usually upon signing, and subsequent valuation is measured at amortized cost using the effective interest rate. So some companies will use zero interest bearing notes as a sales incentive. While they do not state an interest rate, the term zero interest is inaccurate as the notes do include an interest component that is equal to the difference between the cash lent and the higher amount of cash repaid at maturity. So even though the interest rate is not stated, the implied interest rate can be derived because the cash amounts lent and received are both known. So in most cases, the transaction between the issuer and the acquirer of the note is at arm's length. So the implicit interest rate would be a reasonable estimate of the market rate. So next slide, please. So here we have an illustration. So, on January 1, 2021, an entity acquired an equipment for 1 million pesos, and the entity paid a 100,000 pesos down and signed a non-interest-bearing note payable for the balance, which is due after 3 years on January 1, 2024. So there was no established cash price for the equipment, and the prevailing interest rate for this type of note is 10%, and the present value of one for 3 periods is 0.7513. So from the given illustration, we have the given amounts of 100,000 pesos, which is the down payment, the present value of one for 3 periods, which is 0.7513, and so if dili given gani ang present value of 1 for 3 periods, kay makakuha ta og 0.713 by adding 1 to the interest rate of 10%, and i-divide na to og kanang 5 ka click sa equals na sign na mao na magawas ang 0.7513. And the face amount of note payable, which is 900,000 pesos. 900,000 pesos na lang ang atong face amount of note payable, kay since naman kay down payment na 100,000 pesos. And the interest rate, which is 10%. So, as we all know, the down payment, also called a deposit in British English, is an initial upfront partial payment for the purchase of expensive items or services such as a car or a house. It is usually paid in cash or equivalent at the time of finalizing the transaction. So, next slide please. So, in computing for the cost of equipment, we have the down payment, which is 100,000, added by the present value of 1 for 3 periods, which is 676,170. And sa pagkuha sa 676,170, kay gi-multiply na to ang face amount sa note payable, which is 900,000 pesos, sa present value of 1 for 3 periods, which is 0.7513. Mao ng 776,170. Added by 100,000 is equals to 776,170. Mao na ato ang cost of equipment. And for the imputed interest, we have the base amount of note payable, 900,000 pesos, less by the present value of note payable, which is 676,170, which is atong i-compute ganina. So we have an imputed interest of 224,830. So since there is no cash price, ang difference sa face amount of note payable o ang present value of note payable kay mao'y nag-represent sa imputed interest. So next slide please. So here we have our journal entries. First is to record the purchase of equipment on January 1, 2021. We have to debit equipment, which is 776,170. Debit discount on note payable, 224,830. And credit cash, kato imong down payment, which is 100,000. And note payable, 900,000. Second is to record the interest expense for 2021. So interest expense, debit 67,617, credit discount on note payable 67,617. The discount on note payable is amortized as interest expense using the effective interest method. And on the succeeding slide, kay makita na to ang table of amortization and kanang giun sa pag-solve ang interest expense for 2021, 2022, and so on. So, and the third one is to record the full payment of the note on January 1, 2024, which is to debit note payable 900,000 and credit cash 900,000. So, next slide, please. So, here we have the table of amortization. So, we have the date, the interest expense, the discount on note payable, and the present value. So, the present value, we have the 676,170 mo ng present value of note payable, and the discount on note payable, which is the imputed interest of 223,830. So, sa pagkuha sa interest expense for December 31, 2021 kay present value nga 676,170, i-multiply nato sa interest rate which is 10%. Mo nang equals to 67,670. And for the discount on note payable on December 31, 2021, kay less nato ang interest expense nga 67,617 sa discount on note payable on January 1, 2021, which is 223,830. So, mao ng 156,213 ang atong discount on note payable on December 31, 2021. And pagkuha sa present value on December 31, 2021, kay i-add na to ang present value sa January 1, 2021, which is 676,170 plus interest expense na to on December 31, 2021, which is 67,617, morang equals to 743,787. And ang pagkuha sa interest expense for 2023 and 2022 kay same raw process sa katong 2021 and so on, same sa discount on note payable. And on December 31, 2023, kay ang present value nato is equals to 900,000 since mao man nato ang face amount sa note payable. So next slide please. So next would be the fair value option of measuring note payable. So PFRS 9 paragraph 4.2.2 provides that at initial recognition, a note payable may be irrevocably designated as at fair value through profit or loss. So application guidance B5.7.9 provides that amount recognized in other comprehensive income resulting from change in fair value attributable to credit risk shall not be subsequently transferred to profit or loss. So, however, if the cumulative gain or loss recognized may be transferred within equity or retained earnings. So, under the fair value option, any transaction cost is recognized as outright expense. So, the change in fair value attributable to credit risk. So, according to application guidance B5.7.9, so the amount recognized in other comprehensive income or OCI attributable to changes in the fair value of a financial liability deriving from credit risk shall not be transferred to profit or loss. So this means that any gains or losses resulting from credit risk are not moved to the ordinary income statement. However, the cumulative gain or loss realized in OCI that is linked to credit risk may be transferred to equity or retained earnings. So this allows for the reclassification sa cumulative amount inside sa financial statements pero dili sa income statements. So, transaction cost and the fair value option. So, if ang business kay mo choose to apply the fair value option to a financial liability kay mga any transaction costs incurred are recognized as an outright expense. So, in summary, changes in fair value related to credit risk are reported in other comprehensive income or OCI and cannot be moved to profit or loss under PFRS 9. So, on the other hand, ang accumulated gain or loss related to credit risk kay pwede siya makategorize as equity or retained earnings. So furthermore, if a company chooses the fair value option for a financial liability, any transaction expenses are recorded as an expense. So next is there is no amortization of discount and premium on note payable. So as a matter of fact, interest expense is recognized using the nominal or stated interest rate. So when a note payable is issued at a discount or premium, kay walay ka ng amortization of the discount or premium over the life of the note. So instead, the interest expense is recognized using the nominal or stated interest rate specified in the note. So amortization of discount or premium. A note payable has no amortization of discount or premium. The discount or premium is not amortized during the life of the note. So interest expense is calculated using the nominal or stated interest rate specified in the note payable. And the interest expense is normally computed using the sa principal amount and the specified interest rate over the term of the note. So in summary, ang discount sa note payable or premium kay not amortized, and interest expense is calculated using the nominal or stated interest rate indicated in the note. So that would be all for my report, and let me hand you over to the next reporters.
So now, an illustration. On January 1, 2021, an entity borrowed from a bank 4 million pesos on a 12% 5-year interest-bearing note. So the entity received 4 million pesos, which is the fair value of the note, on January 1, 2021. So the transaction cost of 100,000 pesos was paid by the entity. The fair value of note payable was 3,500,000 pesos on December 31, 2021. So the entity has elected irrevocably the fair value option for measuring the note payable. So the change in fair value comprised 50,000 attributable to credit risk and 450,000 attributable to interest risk. So next slide. Here are the journal entries for the illustration for 2021. So January 1, we debited cash 4 million and credited note payable 4 million. And another entry is we debited transaction cost of 100,000 and credited cash 100,000. On December 31, 2021, we debited interest expense 480,000, cash credited 480,000. So in getting the interest expense, we use the percent, which is 12% times 4 million. So another entry is we debited note payable 500,000 and credited gain from change in fair value 450,000 and gain from credit risk OOCI 50,000. So next slide. So in getting the decrease in fair value of liability gain is using the carrying amount, which is 4 million, and the fair value December 31, 2021, which is 3,500,000. So we do deduct it and we get 500,000. So the gain from change in fair value is recognized in profit or loss, and the gain from credit risk is recognized in other comprehensive income. Next slide, please. So here are our members: Cashon Dayan Marie, Fernandez Inoch Lawrence, myself, Paredes Aimee Therese, and Rublico Shella. Next slide. That would be all for our report. Thank you for listening.